Welcome to Opalesk TV. I am in New York together with Larry Morgenthal. He is the Chief Investment Officer and the CEO of UBP Asset Management LLC, which is the US-based entity of UBP, the large Swiss private bank out of Geneva. Larry, thank you very much for having me.
Oh, thank you for coming in.
It's a great day in New York, and I look forward to talk with you a little bit. Let's start about your personal history. How did you become Chief Investment Officer of UBP Asset Management?
Yeah, it was a very interesting road to UBP. I started my career after business school running two very large U.S. pension funds. First, the pension fund of NCR Corporation, and then the pension fund for a Swiss engineering firm, Assea Brown Boveri. And especially at ABB, we were very active in alternatives. We were one of the very early pension plans to invest in hedge funds and to invest in a concept called portable alpha.
When was that? When did you start investing in hedge funds?
So I guess I started investing in hedge funds back in 1994, and industry was still young, and it was really a great time to be starting in the industry, and especially doing it from a pension plan perspective, where for pension funds, it was really a first foray into what we called alternative investments. After the pension plan, I really became interested in the hedge fund world, and I went to work for a firm called Weiss Peck & Greer, which was a provider of single strategy hedge funds, and I ran the alternative investment group there. And we had 10 different single strategy hedge funds covering really every different strategy: convertible arbitrage, merger arbitrage, equity long short, fixed income, and it was very, very fascinating. We sold Weiss Peck & Greer to Robeco, at which point I went to Bank of America, where I was hired to build out an alternatives group for the first time servicing their private bank. So built a fund of hedge funds, fund of private equity funds, and a real estate fund, and grew that to be a $4.5 billion business with about 45 employees and really servicing the needs of the Bank of America private bank. From there, I went to another large fund of funds called UBP Asset Management, where I was CEO, and then I most recently joined UBP about 3 months ago to be CEO and CIO.
Now, Larry, can you tell us a bit about the history of UBP? You're certainly, or this bank is certainly one of the largest investors in hedge funds, and I think a lot of people are curious about what are the roots of UBP.
Yes, UBP was founded in 1969 by Edgar de Picciotto, and it was a Swiss private bank, but the piece it brought that was different was it provided asset management services. And actually starting in 1972, UBP began offering abilities for clients to invest in hedge funds through UBP. So really it was one of the first investors in hedge funds, one of the very first to bring hedge funds to its client base. And that's always been a differentiator of UBP, is that it's been very focused on asset management and at providing hedge funds to its clients. You could almost say it's part of the bank's DNA.
Why is it that hedge funds have such a prominent role within UBP's asset allocation?
That's a great question. What the bank was early at seeing is that clients typically had heavy allocations to bonds and to equities. And what they saw early on was that hedge funds both gave an opportunity to diversify away from those asset classes. It also gave an opportunity for real performance enhancements relative to those asset classes. And third, it gave a real ability to access some of the best talent in the world. So UBP saw early on that lots of good investment talent was moving to the hedge fund space, and it wanted to make sure it could offer its clients access to the very best of breed in terms of taking care of their assets.
Now, Larry, you have been around and have been investing in hedge funds since '94, and UBP as a unit, as you said, much longer and before that. How have you noticed have hedge funds changed during the time from your perception as a hedge fund investor?
Yeah, there's been quite a bit of change. The industry has really, if you will, matured or institutionalized in the early 70s or even the early 90s. There were a handful of hedge funds. They were very under the radar screen, and they were catering largely to a high net worth audience. When you fast forward to 2010, the bigger hedge funds are very much large institutional asset management with very defined infrastructure, And instead of catering to a private clientele, they're really catering to very large institutions, whether they be pension funds or even sovereign wealth funds.
Well, Larry, you yourself have been a pension fund manager, and obviously pension funds will in the next, let's say, 5 to 10 years provide a lot of the additional capital that will flow into hedge funds. So most of the inflows that really experts predict will be coming from the pension funds. How do you think will this change the hedge fund industry?
Yeah, it'll have, I think, a dramatic change. I think catering to the institutions, they really have different sets of needs. So they're much more focused on transparency. They're much more focused on risk management. They're much more focused on size and the value of the brand. So what I think you'll see is a real bifurcation in the industry, that those hedge funds who want to cater to the institutions are going to mostly be larger, and they're going to have much bigger infrastructure. And then I think you'll see hedge funds that, although that's where the assets are, really are less concerned about assets, want to focus on performance, and want to spend less time building infrastructure and managing large teams. And you'll see them stay more of a boutique type style. So I think you'll really see a bifurcation as we go forward, driven by the institutions. And I think you've seen a little bit of that this year, that if you've seen where most of the funds flows have gone from the pension funds, it's to a handful of the very largest. So in this environment, the large are getting bigger, and most of the rest of the industry is suffering for asset flows.
Obviously, every hedge fund will embrace a pension fund and pension money. But however, for the pension fund industry to go into hedge funds and alternatives is not always a smooth and easy path. How can this transition, how can the move into hedge funds and alternatives for pensions just be smoother, and how can hedge funds facilitate this going forward?
I'd like to answer that from a couple of different ways. First of all, you're absolutely right, and I think the very largest pension funds will in fact build their own staffs to be able to understand and manage it. I think for 90% of the pension funds and institutions in general, they will look to work with a partner, and the partner could be a consulting firm. It could be going through a fund of funds like we offer at UBP, or it could be doing customized accounts where it's really a fund of funds for one client, if you will. So I think those are some of the ways where there'll be an intermediary between the hedge fund and the ultimate institutional investor. I think the things the hedge funds can do if they're looking to directly call on pension funds is to be very focused on, the pension funds tend to focus on philosophy, people, process, and performance. And I think if hedge funds begin thinking the way that they know their customer think, they'll be speaking the same language, and it'll make the communication much easier. So they need to be prepared for that. They also need to have the right infrastructure in place to give clients the right reporting, to have people on staff to be able to communicate information, and to try and be very transparent. So I think either the intermediary will come in and help make that transition smoother, or certain hedge funds will sort of understand what the ultimate client's looking for and will try and bridge that gap directly.
A lot of pensions do still have, let's call it, an incomplete perception of the hedge fund industry, which, as we are discussing here, has certainly matured over the last decades. What can pensions do to better understand and use hedge funds?
I'm smiling because there's two ways to think about it. One is someone who's investing in hedge funds today. There's some benefit to not too much money coming into the space. So keeping a few people away is somewhat good for the industry. However, the point is a very valid one, that there's a lot of headline risk and a lot of people being scared as it relates to hedge fund. I think a few things have happened and will continue to happen. One is by working with intermediaries, whether it be consultants or fund of funds. The fiduciaries of the pension fund are using a trained expert in that space, and that helps quite a bit. The other thing that's happened is post-08 and post-other environments, I think both investors and the hedge funds themselves have been much smarter about what risks they're taking and understanding and communicating that risk. Why I feel very positive, though, is having been a pension plan investor, The typical pension fund still has quite a high return target. He has interest rates that are very low. He has equities that are very volatile. And he or she is trying to figure out, how do I meet my return target in close to a zero interest rate environment? And I think although there's some impediments to doing different things, to being in alternatives, I think the nature of the asset liability mismatch that most plans have is forcing them to do things, to be more proactive, to be more creative. So I think the financial pressures of meeting return targets ultimately overwhelms the sort of headline risk issue and gets people to try it. And then as they become more comfortable and more educated and get to know it better, I think you'll see those paths continue. If I can share one short story, when I was starting investing in pension funds in '92 at NCR, we were still debating, is non-U.S. Equities an asset class? Should we be investing outside the U.S.? Fast forward 20 years, and there's really no U.S. fund that doesn't have a very significant allocation to global equities. We're sort of in the same spot today with hedge funds. We're not quite sure. Is it a part of our plan? Isn't it? I'm a strong believer that if we sit together another 10 years from now, it's almost going to be funny to ask, should an institutional pool of capital be invested in hedge funds?
One of the things that has happened after 2008 is certainly that all investors into hedge funds, particularly institutional investors, have heightened the bar in due diligence and monitoring of hedge fund managers. Did you find that all those increased measures were widely embraced, or was there some pushback from part of the managers where they said, no, this is actually not in my own interest anymore to comply with that? And if you had some resistance, how did you react to that? How did you go about it?
A lot did change after 2008, and I think for us in the industry, probably one of the biggest changes has been a very strong focus on operational risk management, or really understanding the back office and the trading controls in place at various hedge funds. A few specific changes we made is we required independent administration from all hedge funds. We also require that we're able to verify assets by doing triangulation, which means getting asset numbers from the manager, from the custodian, and from the administrator. And we've also required managers to walk us through sample trades so we can make sure that all the parts have the right level of controls. To the question you asked, most managers have been very happy to honor the request, and many have frankly changed their procedures because they view what we're asking for is really where the industry has been. Some managers have said no, and it's been difficult. And my view is there's 8,000 to 10,000 hedge funds out there, and I've yet to meet the hedge fund manager I had to be in, or I could not create a good portfolio. So we've taken a very hard line and said if a manager is not willing to meet our standards, we'll go the other way. And our hope is that, one, our standards are reasonable, and as other investors pick those up, it will ultimately force more managers to come to agreement.
Yeah, I think this has really happened. I remember in 2008 that you came out with this requirement only to deal with managers that do have a third-party administration. And certainly this request has now been embraced by and demanded by much more investors globally.
Yeah, no, we were very happy that almost all the managers we worked with were willing to accommodate that request. And I think the important thing for a manager to see is that we're not asking for requests to be onerous on the manager, but because we think it's best practice. And ultimately, most managers agree with that. And frankly, once they implement some of the changes, it's helped them appeal to a much broader audience. And what we were discussing before about the institutions, it definitely helps them being much more suitable for institutional investment.